All right, you have spent the last episode learning how to meticulously stitch interest costs into your assets like a master tailor, only for the IASB to throw a bucket of ice water on you. You've got an asset, maybe it's a field of prize-winning grapes or a luxury apartment complex, and because you've decided to measure it at fair value, the over-caffeinated lawyers tell you that IAS 23 is suddenly optional. It feels like you've been disqualified from a race on a technicality. You're doing the work, you're paying the bank, and yet you cannot hide the cost. If you feel like the rules are being made up as they go along just to keep your P&L looking like a crime scene, you are officially one of us. Imagine you are building a house. In a custom build, like cost model, you track every single cent, the lumber, the nails, the architect's scotch, and the interest on your construction loan. At the end, the cost of the house is the sum of all that pain. If you spent $50,000 on interest, the house costs $50,000 more. Now, imagine you are a house flipper, a fair value model example. You don't care what you spent on interest, you only care what the guy down the street is willing to pay you for the finished kitchen. If the market says the house is worth $1 million, it's worth $1 million. The market does not care if you have a 2% interest rate or a 20% interest rate. If you try to tell a buyer, well, I paid a lot of interest, so you owe me an extra $50,000, they will laugh in your face. In a fair value world, the price is the price. The interest you paid is your problem. Under IAS 23, in case of qualifying assets measured at fair value, an entity is not required to capitalize borrowing costs directly attributable to the acquisition, construction, or production. Fair value, like IAS 40, investment property, or IAS 41, biological assets, already reflects the time value of money. A market participant buying a half-grown forest or a half-finished mall has already factored in the cost of capital. If you capitalize the interest and then marked the asset to fair value, you would be double counting by adding cost on top of a value that already includes that cost. You have a choice. The standard says you are not required to capitalize. This is a rare moment of freedom in IFRS. Most companies choose to expense these borrowing costs immediately because it's cleaner. Why track complex capitalization rates when the fair value adjustment at year-end is going to wipe out or overwrite those costs anyway? Think of a vineyard. It takes years to produce wine-grade grapes. Under IAS 41, those vines are measured at fair value. The interest on the land loan? Straight to the bin. The lawyers decided that nature's growth should not be cluttered with your banking arrangements. The fair value exception is the IASB's way of saying, we don't want to see your math if the market is doing the talking. If you're measuring an asset at fair value, treat IAS 23 like an uninvited guest at a wedding. You can let it in, but it's much easier to just leave it at the door. Expense the interest. It keeps your balance sheet pure and your audit much shorter.